You pay off a loan, open your credit app, expecting your score to go up, and it drops. So now you are sitting there thinking, how did I get punished for paying off debt? Here is the stupid part. Your credit score may have liked that loan more when it had 500 left on it than when it hit zero. And once you understand why, the whole thing stops feeling random. First, your credit score is not just a reward system for a good financial behavior. It's not sitting there thinking, wow, you paid off debt? Amazing. Here are some bonus points. That's not what it does. Your score is doing something much narrower. It's looking at your credit profile and asking one question. Based on what this person's account look like right now? How risky do they seem to a lender? That's it. And that matters because paying off a loan can be a smarter move for your actual life and still cause your score to dip for a while. Those two things are not in a conflict because your score is not measuring did this person improve their life this month. It is measuring did this person credit profile just change in a way the model like less. That's the frame you need for the rest of the this to make sense. Now let's get to the part that actually explain the drop. If the loan you paid off was something like a car loan, a student loan, or a personal loan, that's an installment loan. And this is the weird part. An installment loan can help your credit profile the most right before it disappeared. Let's say you borrowed 25,000 for a car. You make a payment on time. You do everything right. Now the balance is down to $500. From your point of view, that loan is basically over. But from the scoring model's point of view, that account may still be helping you in two ways. First, it's still an active installment account. That matters because if most of your other accounts are credit card, this loan add a different type of account to your profile. So the model says, okay, this person has handled revolving credit and installment credit that can help. Second, it's an active and almost paid off. And this is the part most people never told. An installment loan that's still open and nearly paid off can actually look pretty good on a credit report because now the report is basically showing this person borrowed money, they paid it on responsibly, they keep the account in a good standing, and they are almost done. That's a strong signal. Then you make the final payment, and account goes from active installment account, almost paid, still helping the profile, to closed account. And that can be a moment the score dips. Not because paying off debt was bad, not because score wants you to stuck in the payments forever, but because an active account that was helping your profile is no longer an active. Your score didn't drop because your debt is good. It dropped because an account that was helping your profile while it was open just disappeared. That's the real mechanism. And this is exactly why the whole thing feels so ridiculous. Because in real life, paying off the loan is usually a win. You owe less. The monthly payment disappeared. Your cash flow gets better. You may save interest. You have one less bill hanging over your head. That's a real progress. But your score is not measuring whether your life got better this month. It is measuring whether your credit profile changed. So yes, you can become financially stronger and you still see your score wobble for a bit. That doesn't mean paying off the loan was a mistake. It means your score like the structure of that account while it was still alive. Now, before you blame the loan for everything, there is one important layer here. Sometimes the score drop really is tied to the payoff, but sometimes the loan get blamed for all it when something else changed at the exact same time. There are three big suspects. Number one, your credit card balance reported higher that month. This is super common. Maybe you paid off the loan, but your card reported a bigger balance than usual. Life kept happening. Groceries, travel, bill, whatever. If your card balance is reported higher, your utilization may have gone up and that alone can hit your score. Second, you applied for a new credit around the same time. Maybe you open a card, maybe you finance something else, maybe you applied for another loan. A hard inquiry or a brand new account can absolutely move the score you are looking at. Third, you are comparing different score without realizing it. One app says you dropped 22 points, another barely moved, another hasn't updated yet. So now it feels like the whole system is junk. But you do not have one magical universal credit score. You have multiple scores from a different bureaus using different models, dating on a different timeline. So, if your score dropped after paying off a loan, don't just ask, did the payoff hurts me? Ask the better question. What changed on my credit report during the same window? Because sometimes the payoff is the reason. Sometimes it's the only part of the reason. And sometimes it just happened at the same time as something else. Now, let's talk about the move that can make this situation even worse. Because this is where people accidentally turn one score dip into a bigger one. You pay off the loan, feel motivated, start cleaning up your finances, and then close a credit card you never use. That can be a terrible timing because closing a card can reduce your total available credit. And if your available credit drops while your balance stays the same, your credit utilization goes up. Let's take an example. Let's say you have a credit card A with a $2,000 balance and a $5,000 limit. Card B with a $0 balance and a $5,000 limit. Across both cards, you have got $10,000 of the available credit and $2,000 in balances. That's 20% utilization. Now, you close card B. Your spending didn't change. Your balance didn't change. But your available credit limit just dropped from $10,000 to $5,000. So now, that same $2,000 balance become 40% utilization. Same debt, same spending, same person. But on paper, you suddenly look riskier. So if you just paid off a loan and your credit score dipped, this is not the moment to start rage cleaning your credit accounts because now you may be staking a utilization problem on the top of a loan pay effect. So, did you actually made a mistake by paying off the loan? In most cases, no. And this is the part I really want to separate clearly. Your credit score and your actual financial life are related, but they are not the same thing. If paying off the loan means one less monthly payment, less debt stress, more breathing room in your budget, less interest going forward, more flexibility with your cash, that can still be a very good move, even if your score gets weird for a while. Because the goal is not to stay in a debt forever, just to keep a formula happy. The goal is to be stronger financially and keep a healthy credit profile where you can. So, if you can pay off the loan and your score dipped a little, the lesson is not I should have stayed in a debt. The better lesson is my score may have lost an active account that was helping my profile, but that does not automatically means paying off the loan was a bad decision. That's what actually happened. Now, a small drop after paying off a loan can be normal, but there are few situations where I would absolutely slow down and inspect the report. Red flag number one, a late payment showed up. If the lender reported something incorrectly around your final payment or the timing got weird, that's not the same thing as normal profile change tip. Red flag number two, the account is being reportedly wrong. Maybe it is still show a balance, maybe it doesn't show paid correctly, maybe the status looks off. Red flag number three, something else changed at the same time. The card balance spiked, a limit got cut, a hard inquiry appeared, an old card got closed, or there is just a reporting error somewhere. So, if the drop feels too big, too sudden, or just plain weird, don't sit there refreshing the score and panicking. Go look at the actual report because my score dropped is the symptom, the report is where the diagnosis lives. If this just happened to you, here is the move. First, don't panic and start changing five other things. No random card closures, no panic applications, no weird I need to fix this by Friday behavior. Second, check your credit report and make sure the loan is reported correctly. You want to see paid correctly, closed correctly. No surprise late payments, no weird leftover balance, and no unrelated charges you missed. Third, keep your credit card balance boring for a while. No utilization, on time payments, no drama. And fourth, ask the real question. Did paying off this loan improve your actual financial life? If the answer is yes, less debt, better cash flow, less stress, don't let the temporary score move trick you into thinking the whole decision was wrong. So, if your credit score dropped after paying off a loan, the clean version is this. You probably didn't get punished for being responsible. What likely happened is that you removed an active installment account that was helping your profile while it was still open, especially if it was almost paid off. That's why the drop can happen. And the biggest mistake after that is learning the wrong lesson. The lesson is not I should stay in a debt, so my score stays happy. The lesson is a credit score reacts to the changes in your credit profile. It does not always reward financial progress in real time. Once you understand that, the drop stop feeling random. And most importantly, you stop making your next move based on panic because the goal is not impress a credit score for 1 month. The goal is actually get stronger with money. And if your score is little annoying for a month after that, that still doesn't mean you are made a bad decision